valued, owned by a business expected to provide future economic benefits. A business assets are recorded in the balance sheet and can include cash, inventory and stock, accounts receivable, and plants and equipment. Assets are a fundamental part of a business's accounting practices as they generate income and provide return for the stakeholders, increase the value of the business, and facilitate the short and long-term operations of the business. It is imperative that a business knows how to properly manage their assets, as poor asset management can result in major losses, inefficient operations and resource allocation, incorrect financial statements, and lowered business worth. Internal stakeholders need to be aware that there are two types of assets, current and non-current. A current asset, which includes cash and inventory, will be generated into cash within the year, whereas a non-current asset, like vehicles and buildings, are part of long-term cash gains.
A liability is something the business owes or an external claim on the business's assets. Liabilities are then settled over time through either cash payments or exchange of goods or services. As assets are, liabilities are also recorded on a business's balance sheet. Liabilities can be either current or non-current, with current liabilities being settled in 12 months or less, such as overdraft, accounts payable, short-term loans, and accrued expenses. Or non-current liabilities, which include long-term loans such as mortgages, which last for a period of longer than 12 months. Liabilities can provide the business with instant access to funding, which can greatly enhance the financial position of a business, both in the short term and in the long term. However, too many could sink the business. A business has to take caution with the liabilities it incurs, as improper management may lead to large losses for the business. Proper management will keep the business afloat.
Business income is any income realised as a result of business activity. A business's income can include monies earned from sales, royalty payments, interest earned, rent received, and subscription fees, to name a few. Generating income is an essential component of any successful business operation. It is crucial that managers understand just how their business's income is generated and are able to properly read and interpret income statements, which detail a company's revenue and expenses over a period of time, and how these translate into a profit or a loss. Failure to understand this information can result in untenable losses, gross inefficiency, and incorrect financial statements. Managers must also be on the lookout for new sources of income that will allow their business to expand its operations, grow in value, and increase returns for stakeholders.
Within the accounting and financial world, capital refers to funds raised to support a business or venture. Capital can also represent the accumulated wealth of a business, represented by its assets less liabilities. This is known as the working capital ratio, which divides current assets by current liabilities. But why is this important? On one hand, business capital is important as it measures a company's ability to settle short-term expenses or debts. On the other hand, too much working capital means that some assets are not being invested for the long term, so they may not be put to effective use in helping a company grow as much as possible. Further to this, Corporate Finance Institute actually explains that capital is anything that increases one's ability to generate value. When diving down further, capital in a business sense can include all three of the broad categories, including financial, human, and natural. Business capital comes in two main forms, debt and equity. Debt is a loan or financial obligation that must be repaid in the future, and equity is the ownership stake in a company, and unlike debt, it doesn't have to be repaid and doesn't have an interest expense associated with it. In business, a company's capital base is vital to its general operation. Deprived of satisfactory capital, you may find that a company isn't able to afford the assets required to function and last.
Regardless of what business type is used, whether it is a sole proprietorship, partnership, or limited company, they all have expenses of some kind as inputs to generate future wealth for the firm and its shareholders. It can be said that expenses are what a business spends or pays to receive a benefit, and once an expense is paid, it becomes a liability paid. A few examples of expenses include rent, electricity, water, maintenance and salaries. Effective management accounting is crucial for a business to remain profitable by monitoring targets and actual outcomes. where in the event that actual expense figures are greater than the targets, it is beneficial for management to investigate the cause of discrepancy and trim the fat to minimise the losses occurred. In the event that this is managed poorly, it is essentially throwing money away, and we can't have that because we need to keep the business moving.
The balance sheet, also referred to as the statement of financial position, is used to show the current financial position of a business at a particular point in time. It incorporates aspects of ALICE. These include assets, liabilities, and the equity position of the business. The purpose of the balance sheet is to give accountants, managers, and the business owners a snapshot of the current financial standing of the business so they can make decisions accordingly. The first element of ALICE, assets, are listed on one half of the balance sheet. On the other side of the balance sheet, we list the claims against these assets. There are two types of claims: external claims, which are liabilities, or internal claims, which is owner's equity or capital. By listing these claims against the assets, this brings the statement of financial position into balance. Therefore, it can be illustrated that the balance sheet is closely related to the accounting equation assets equals liabilities plus equity. However, we must take note that when writing the balance sheet, there are two significant factors that influence the content of the financial reports. These include traditional accounting conventions, also known as GAAP, and continued development of professional and statutory accounting standards.